Okay, I think we'll get started. So, thank you all for joining us today. I'd like to welcome you to today's webinar discussing the value of mortgage servicing rights. This webinar is part of the CWDL webinar series on key mortgage industry topics for our clients and friends in the industry. We're extremely excited to have our guest and MSR expert, Seth Sprague, CMB, principal at STRATMOR Group, joining Dustin Fluger, CPA, mortgage banking partner at CWDL. Quick intros on Seth and Dustin. Seth Sprague joined STRATMOR Group as a principal early in 2019 with more than 20 years of mortgage banking and servicing valuation experience. Seth specializes in mortgage servicing rights, servicing, cash flows, liquidity, and mortgage profitability strategies. Seth serves on many MBA committees and is a teacher, advocate, and leader in the mortgage banking space. We are beyond appreciative of his time and know he's going to add a ton of value to today's webinar. Dustin Fluger joined CWDL in July of 2020 as the partner of mortgage banking with more than a decade of highly specialized mortgage banking focus and nearly 2 decades of consulting and accounting experience. Dustin attends and regularly speaks at various mortgage industry conferences and serves as a board member and member of the executive committee of the TMBA. So thank you both for your time today. Couple of housekeeping items. Feel free to type in your questions into the Q&A. We'll do our best to get to all of them. If we don't, we will circle up with you guys after. We're also going to send out a recording of today's webinar either later this afternoon or first thing tomorrow. So with that, let's get started.
Thank you, Casey. Yeah, thanks for the introduction. I think the one thing, I think, Seth, you're a CPA too, aren't you? Or a past CPA? Or
I passed the CPA exam, the state of Virginia, and the ethics exam, but I've never been officially licensed. And because I took the ethics exam, I can't say I'm a CPA, but I could have been. I did work 3 years in public accounting at KPMG.
Okay, I knew it was something. I knew it was something like that. It was. I knew you had an accounting background, which is always nice for this kind of stuff. So yeah, so I mean, I guess, just to lay out kind of the webinar and what we're going to talk about, I think we're, we were going to kind of just talk through what's happened over the last year. We're almost, it's hard to think, imagine that we've got almost a year out from, the world dropping out from under us as it seemed at that time, and everything happening, at the end of last March and beginning of April. And then just kind of talk about, what happened over the year, talk about, trends in both servicing and other, just trends you're seeing, and then kind of to get into, what we see coming, and what issues we see happening, and what happened at the into February, how that's going to look, going forward and stuff. So I guess with that, I mean, let's just jump into talking about last year. We won't spend much time harping on the past that far back, so I think everybody knows. But I remember, Seth, last year, probably maybe 3 weeks, a month from now, we got you on a call with a bunch of, other CPAs in the space, and just, we're talking through this issue of, the values in servicing going to zero. And I think everybody in the space kind of agreed, like, I mean, I think there's no trades, there's no active market, but the value being zero just didn't make sense and what to do. We had clients asking us whether they were off year ends or, for quarterly reporting. We kind of got you on, and, I guess let's just start there and just kind of talk, what just happened, maybe high level, what, what's going on, and then just touch on that subject of, was it really zero? Was it something else? What was the best estimate? That kind of thing. So, yeah.
Yeah, it's a great question, and it's hard to realize that a year ago is when we all were hunkered down, went home, and the MSR market literally cratered. And I can remember being on calls with warehouse lenders initially in early March, and they were saying, hey, we don't really like the way this is going. We were going to start backing out of some Ginnie Mae. But on the servicing valuation side, values did not go to zero, and I think I hopefully said the same thing to your accounting folks a year ago. And and there's a lot of data out there, and I spend a lot of time looking at the data from peer companies. But to give you a little bit of perspective, values dropped generally the first quarter last year. So from 12/31/19 to Q1 2020, they dropped around 27% in value across a pretty wide swath of banks. And generically speaking, people had servicing around 100 basis points at the end of the year, and generically speaking, they had it, around 70 to 73 basis points at the end of the first quarter. I will note, though, that we saw wide dispersion in the first quarter across valuation firms. If we remember back to mortgage rates, and I think we've got our friends from Optimal Blue Black Knight on the call as well, so we'll give them a shameless plug here on the rate index. But if you go back and look at go to the Optimal Blue website and look at rates last March, you'll actually see rates kind of increase for part of March, and that was really a function of just the uncertainty of where were loans going to be sold and who would buy them. And what I observed across valuation firms, particularly with the first quarter results, were some people actually tried to write up their MSR values at the end of the first quarter because, mortgage rates are higher. I'm like, yeah, you can't write it up, right? I mean, we're in the middle of a crisis, forbearance, but some of the firms out there, the big firms that do a lot of valuation work, actually were telling people that Q1 values were higher than year end. And I said, not possible. But they were using sort of a viewpoint of mortgage rates and looking at sort of rate sheets and going, well, mortgage rate sheets are higher, so servicing values are higher. And I'm like, you just missed everything that just went on. And what we found was those firms that sort of missed Q1 and didn't write down values high enough in the first quarter, then chased it the rest of the year. They took values down in the second quarter, where everyone else was kind of flat in the second quarter. And so your valuation provider really could have created some volatility there. I'll tell you that most of the large banks experienced that right off in the first quarter. And values actually sort of were flat in the second quarter, down a little bit, but then they started to recover. And I still see some of the valuation firms out there struggling. I call it the portfolio reset phenomena, but if you look at your portfolio as of March 31st, and then you look at it as of year end, you'll see you have a vastly different portfolio, likely 30 to 40 basis points lower in WAC. And therefore, your value has come up merely from the fact that you have a better portfolio. It's a lower WAC portfolio. You refinanced it. And so values never went to zero, though they certainly went to zero in the co-issue market, and aggregators backed out of the market as well. And so that's where the challenge really was. And I'll pause there because I could kind of talk on this for like an hour, but and relate stories back to HARP days and everything else. But you really should have seen that big write down in the first quarter of last year, around 25-30%, and then kind of flat second quarter, and then increasing third and fourth quarter.
Yeah. I always appreciate that bit about you. You can talk about this stuff for hours, and you can make it interesting too. I mean, it's not just. I think it can be a very dry, boring subject, and you could, So that was my next little just piece on that. So you said Q2 they kind of stayed flat. Then I know we've probably been seeing them for year end. The valuations coming in between 80 and 95 basis points for this year end. So that really started to come back, and would you say like Q3, Q4 really is what was driving that back?
Yeah, Q3 and Q4 is where we saw a lot of that value coming back in. I would say that generically speaking, values at Q3 sort of matched Q1 if you took the appropriate write down, and then they increased in the fourth quarter. So I would say, yeah, across that range. Look, I know we got a lot of accountants on the call, and every portfolio is going to be different, but the range that you highlight there is sort of consistent. What we didn't really see recover at all was the bulk MSR market. And I'm probably jumping ahead because, Dustin, I can't stay on topic, but, the bulk MSR market really never recovered in the fourth quarter. It's somewhat recovered so far this year, and we'll get to that. But if you think about it, as rates were falling, nobody had enough portfolio or MSR portfolio that was at or below current coupon to sort of sell. So the bulk servicing market really did seize up last year, just due to the fact that, you had higher coupon WACs and it was premium pricing, premium prepayment speeds, and you weren't going to be able to get pricing for it. That's come back a lot in the last, 60 days. But yeah, that recovery really is in the fourth quarter, third and fourth quarter. And it still concerns me. I still see some valuations that are like lower in the fourth quarter than they were as of March. And I'm like, this doesn't make any sense. That's a valuation that's sort of either the portfolio hasn't reset in terms of lower WACC or better characteristics, or something's going on with that prepayment model, because prepayment speeds looking forward should be slowing, not increasing.
Okay. So I mean, with that, I mean, there's a couple of different ways, I want to go, with this, but just talking, since you were, talking on this a little bit, something we've seen, which is interesting. It kind of reminds me of, God, I don't even remember the years back, 2012, maybe 2013, when a lot of people jumped into the market all of a sudden. Like, we got a lot of clients just all of a sudden, over the year trying to rush their, Fannie, Freddie approvals, trying to get into it. I mean, I've seen some weird stuff that I haven't seen in 15 years of doing this. People also doing weird mini core and correspondent relationships between independents. I mean, what have you seen on that? I mean, I guess what's driving that? Let's talk about that. So.
Yeah, let's just say it's been a really busy year for me at STRATMOR, trying to advise folks on their servicing strategy. So there's a shameless plug for the work I do at STRATMOR. I'm trying to help people understand. And really what I try to focus people in as on the cash, right? What's the cash give up of retaining servicing? And so what you saw as the co-issue and the correspondent market really collapsed in March and April was those that had tickets, agency tickets, the ability to deliver loans directly to the agencies, pretty much start delivering everything to the agencies. We'll come back and talk about what those risks are now that they delivered, but they pretty much started to retain servicing. And so the poor sub-servicers out there just got swamped, right? Somebody was giving them 1 or 2 loans a month, now gives them 1,000 loans or 2,000 loans. So the strategy was to retain servicing because it was, quote, the better execution. And I would agree, on paper, it looked like better execution, but I always caution people, make sure you understand the servicing that you're putting in your portfolio. Loading up your servicing portfolio with 620 and below, 97% LTV FHA servicing that may be 10 to 15% in forbearance by the end of the year probably is not a long-term strategy. And even though an aggregator may have offered you a negative price for that MSR, that may look like a good deal now, right? As you kind of in the throes of servicing. So a lot more people retained a lot of servicing. And I think to some degree, and we always have talked about this in the industry, and again, we've got aggregators on the phone, and aggregators serve a critical role. But when you talk about the ease potentially of an agency delivery and the timing of delivery, one thing I always want to highlight is, and I don't mean to sort of throw Fannie and Freddie under the bus, but they don't do QC on your loans when you sell them the loans, right? They check the data. Does the data check the box? Does it meet the ULDD requirements? And then they buy the loan. Aggregators are going to do QC work on your loan. And, and the STRATMOR stuff shows, somewhere between 20 to 30% of loans that you try to sell to an aggregator are going to get kicked, at least initially. They're going to have, quote, pens on them, right? And so if you think about you now selling that to the agencies, you still probably have 20 to 30% pens on it. And so what does that repurchase risk look like going forward for you? I think it's a huge issue that we're going to be addressing this year. But no, definitely a lot of people retain servicing. They retained it in larger amounts than they ever have. I'm hoping that they did a strategic review. I hope when they're engaged somebody that looked at it and said, you shouldn't be keeping all this risk. You should at least be diversifying your risk. But you as an auditor and all your brother and accounting firms are dealing with a lot of companies this year that have MSR assets for the first time going across a year end. And I'm just going to guess that you're finding all sorts of accounting. I know I've got some clients I've been working with on their accounting side, just trying to get their accounting basics done, because it's sort of one of those assets that most people don't, one, understand the accounting, and two, they don't have a lot of familiarity with it. And so it's been a busy year just trying to keep people, did you adopt fair value or low com? And they look at you like, I kept servicing. I'm like, yeah, I know you kept the servicing, but like, how are you treating it? And they're like, well, I get a valuation. And I'm like, and so what do you do with the valuation? And they're like, I write the number to the valuation. I'm like, well, how are you proving that the valuation is correct? I'm like, I think we need to hire you to do some work for us. And I mean, I say this facetiously, but it's been a busy year, as you might imagine, just being on the consulting side, just trying to help people stay aligned.
Yeah, no, and that's where I get to, that it does remind me of back whatever those years were. I mean, when I was very new into the industry. I think I've been here 3 years or so, and everybody rushed in. I mean, I think we had 1 or 2 independents that were servicing before, and then all of a sudden by like the following year in, we had 20 or something ridiculous. So and that's what this year reminds me of. I mean, it's very similar. And we have clients that's actually on this call. They sold their entire portfolio in February of last year, and now their portfolio is bigger than it's ever been, I think, as of the end of this year. So they've just built that back up and gone there. So with that, you touched on a couple things there that you kind of alluded to. You brought up something when we were planning on this the cash window caps per agencies and what that means and how that goes. You want to touch a little bit, because I hadn't heard much on that, so I think that would be something, if you want to touch a little bit on that and what you're seeing or what's coming, that kind of thing.
So January 14th is a day, not to steal quotes from previous presidents, but is a day that may live in infamy in the mortgage banking space. The Treasury announcement, which was initially, hey, the Trump administration isn't taking Fannie and Freddie private before the end of the administration. So everyone was like, hey, great news. They're not rushing them to become out of conservatorship. But also embedded in that announcement was a couple of gems. One of those gems was imposing a $1.5 billion annual cap on the cash window deliveries per agency starting next year. And that's a rolling 4-month quarter type of analysis in 2023. So you get 1.5 billion potentially in 2022, and then it's a rolling from then on, assuming it doesn't change. Well, a lot of the aggregators, a lot of the independents, a lot of people that retain servicing, we're just keeping, we're selling to the cash window, whether it's Freddie's cash window or Fannie Mae's cash window. And, they potentially could get squeezed out of that cash window delivery starting next year, when they'd be forced to move to, a UMBS or an MBS execution, and or they have to sell to aggregators, right, who are going to create the securities in the back end. So it could be a real windfall for the aggregators. Now, that's only part of the announcement. Second thing that if we've got secondary marketing folks on the call, I'm sure they all have gotten their call from Fannie and Freddie in the last week. I was talking to somebody literally yesterday, and the email came over because I was like, hey, you've got 10% of your February production is in second home and investment properties. And they're like, yeah, literally 3 minutes ago, we got notification from Fannie Mae that we need to curb our second home and investment properties because the agencies are now going to be limited to 7%. So where does the rest of that stuff go will be a question. And how do you manage a company when you're taking an app now and you might not have a saleable loan to the agencies in 60 days? So that's another concern. There's also the high risk stuff, right? They're limiting the high risk, high LTV, low FICO stuff that is a lot of home path and home ready product. So again, we sort of get this confusing message of we want to do this product, but don't do this product. Which product do you want me to do? The bottom line is secondary marketing desks and secondary marketing advisory firms are going to be more stressed and more important as we go through the rest of this year, as people need to prep for UMBS securities. And we could talk about the differences between MBS and actual or schedule actual servicing in a little bit, but it really is, it is going to squeeze out a lot of those middle tier IMBs, right? If you're a shop that does 750 to $1 billion a year, these rules probably aren't going to be hitting your radar, and you can just continue to do whatever you do in the industry, right? Whether you retain servicing or not retain servicing, it probably won't have a big impact for you. But it could if your aggregators are over 7% on second home investment properties and you're at 10%. And so it just adds stress and costs to the overall sort of mortgage ecosystem. And I think what you'll see and it is an increase in M&A activity. I think you'll see more companies sort of saying, "Hey, look, this just isn't for me. I had a great refinance run, man. 2020, I banked it. I'm doing good the first quarter of this year, but I went out. There's just too many rules. The regulations are not possible." And that's before we get into some of the CFPB stuff as well. So I'll kind of pause there, and you can redirect me.
Yeah, no, I think that's great. I mean, I think, that's appropriate. I actually do want to touch back on the M&A stuff here in a minute, and thoughts when we talk about what's coming. Definitely want to get in that path. The one thing I did want to jump back to a little bit, just in terms of just servicing, and you touched on it, and, I think we didn't touch exactly, just the forbearance issue and what's happening there. I mean, I know, back probably pre-COVID, I think, the forbearance rate was below 1% is what I saw. Then it jumped up to, up over, 8%, sat there through maybe July. And then it's been slowly dropping back down to, I think it's, as of March 15th, it was like 5.14% on average there. So what, I know there's a lot of talk about it in July, or, May, June and July, that, it's probably people that didn't really need forbearance, that were hitting the button, doing stuff like that. So, I mean, what do you see? Do you think 5.5% roughly is a real, I mean, do you think that's really where we're at? What do you think? And then how does that affect, and what do independents need to think about, when they're thinking about that long term and stuff? So, yeah.
Yeah. So the whole forbearance topic, I guess let's start on the good news front. I think a year ago, when we were starting fully into this COVID crisis, people were estimating that the total number of forbearance loans could be as high as 50%. Okay. People are, I ran a simulation for somebody. Again, I'm not in the MSR valuation business, but I do a lot of sort of cash flow analysis for folks. And my phone was ringing off the hook going, "Hey, if 25% of my servicing portfolio goes into forbearance, am I going to run out of cash?" Because, I'm getting whacked on my TBA side as well. And the answer was yes, you'll run out of cash at 25 or 50% forbearance. In fact, I had a conversation with a large aggregator. I was like, this is the time to double down, man. Like, look, if it gets that bad, the last thing you need to worry about is you had more servicing. Like, if we hit 25 or 50% forbearance, the world's kind of over for mortgage banking, and we're going to be looking for new jobs. So I was like, I'd double down. I mean, you may as well just take the risk. They did peak out, in sort of that, I don't know if it was 7 or 8%. And a lot of people went into forbearance initially, and those initial numbers show, 40% were still current, or 45% were still current, and then it's 30% current. So a lot of people went into it as an insurance policy. If you went into forbearance and stayed current, you could pretty much refinance your mortgage. You could kind of do what you needed to do, right? I mean, it wasn't a draw, a negative impact to you. And a lot of people went into it sort of thinking, geez, I don't know if I'll have a job in 30 days, so I'm going to hit forbearance button. You start to see those initial ones come out, and I think the Black Knight data from their market monitor shows about 77% of those that were current going into forbearance, so current as of last February, that went into forbearance have come out, are either performing or they're doing okay. Very few loss mitigations. The problem is the number you alluded to now. There's a lot of borrowers, 2.65, 2.7 million, 5.1%, 5.2% of the mortgages out there that have been in forbearance now for 12 months or will be in forbearance for 12 months. And what does their outcome look like? And again, that's going to be a little bit heavier on the loss mitigation side. Now, on the positive side, unlike the last financial crisis of 07 and 08, property values are at all-time highs. I made a really bad joke with somebody who was golfing the other day. As I know the guy was a golfer, and I was like, literally, I think if you're on the golf course, if you say 4, somebody tries to buy your house from you because they think there's going to be a sale behind it, not to duck and cover from a golf. It's a pretty bad golf joke, I know, but it shows you the state of the housing market, right? There's a lack of inventory in the housing market, and so the folks that have been in forbearance and have not made their mortgage payments actually are probably in a better equity position in their house than they started this. The key and the absolute key for servicers, and the MBA had this on their town hall call yesterday, is going to be the education and the outreach for servicers to make sure that those borrowers understand the financial position they're in. Servicers don't want to kick people out of houses, and they don't make money on foreclosures. But what they need to be able to do is engage with the borrower to figure out what the logical step is. And, hey, Dustin, if you can't make your mortgage payment and you can't become current by just making your next payment, we'll tack all this other stuff on the end, right? As a second, not charge you interest, it's not forgiven. It's just tacked out at the end. It's kind of that silent second. But you have equity. So is it better for you to sell the house and rent for a year? Is it better for you to sell the house and rent for 6 months? Again, there's no inventory, but you could sell your house quickly. And that may be the saving grace for servicers, but the issue is going to be, can they get in touch with the borrowers? And I believe, and I'm not the one writing the rules on this, but I believe if you want to extend somebody after those 12 months of forbearance, you actually need to contact. You need to have a legitimate point of contact with the borrower and understand the hardships so that you could kick them down the road another 6 months. And so if the servicers can't reach out to those borrowers, they're going to take them out of forbearance. And if the borrower still thinks they're in forbearance, they're going to show up as delinquencies. And we'll have a real issue on our hands as in servicing at that point, if that's the case. We might as well arc to one of the elephants in the room. Is that, a lot of the positions, including the head of the CFPB, is going to be Elizabeth Warren type appointees. And they have no tolerance for what this will be perceived as impacting borrowers adversely. And so the industry needs to be very much aware of the changes at the CFPB and some other critical positions are really being driven by sort of Elizabeth Warren. And I was with a bunch of mortgage executives after the last presidential election, and they were talking about the DOJ risk and talking about this and talking about that. And the thought in the room was that Trump would probably only be a 4-year president. I actually thought he'd probably make it about 2 weeks before he would quit. He did sort of serve, I guess, for the 4 years. And they said, do you want to stake your business model on Elizabeth Warren win the presidency in 2020? And there was just dead silence in the room, right? Because the pendulum swings at the CFPB are going to be severe. They are going to be dramatic. And I think we've sort of forgotten that we've had a benevolent CFPB for the last 4 years. And that is not the case anymore. And that is a real risk for mortgage servicers. It's a real risk for mortgage originators. And it's just something to be aware of that, your business model and your risks are much more elevated now, which drives higher costs, higher compliance, higher risks. And really at the end of the day, those CARES Act forbearance plans, we're going to have to treat, we will treat them, but we need to make sure we're getting to the right contact. And I don't think, Maxine Waters' Housing Finance Committee is going to want to hear as mortgage servicer go, well, we tried to reach the borrowers and we couldn't, so we took them out of forbearance. I just think that's going to play very poorly in Washington, D.C. When it comes to mortgage servicers and a lot of them are FHA borrowers, which are first-time home buyers. It's not going to play well.
So speaking to that, and this is a little bit, it's on topic, but it wasn't on, some of the stuff we discussed before when we were planning for this. I think what complicates it a little bit more, especially for the independents and the smaller independents, the big guys of the world have this all down, but a lot of them are using, sub-servicers, and they have a, middleman in there, and the smaller, I think everybody knows that, you have oversight over your sub-servicer, it's your responsibility, but in practice, I'm not sure how much that happens with, smaller independents, mid-sized independents. What if you were talking to a small or mid-sized independent, what were your thoughts on advising them on that? If they're just like, oh, well, the sub-servicer is just handling that, we're not going to worry about that. What's your thoughts? And there's new sub-servicers in the space too that we all know of. So that's a whole nother point of that. So yeah.
Yeah, not having the proper oversight is going to be a quick way, I think, to putting yourself into the side of the box that you don't want to be in, right? I think it's going to be incumbent on these entities to make sure they're demonstrating the proper oversight and they're ensuring that there's, equivalent treatment across all borrowers. And there's a lot of work being done in DC, and there's a lot of topics around DC flying around. I think sub-servicers are going to be in a tough pickle here. And I think people using sub-servicers are going to get greater scrutiny. It's one thing if you service in-house and you can kind of control that messaging, but just to say, hey, I've kind of outsourced that, I'm not really doing much with it, that's not going to be an appropriate answer when the CFPB comes in and does an audit. And so they're going to want to see how you're doing that oversight. So we strongly encourage folks, look, you got to have the right policies and procedures. First off, you got to hire the right servicing manager. Second off, he or she needs to make sure that she's actively engaged with the sub-servicer, and you're making sure that you're getting to that messaging and you're tracking this, right? Hey, you've got X borrowers coming out of forbearance in 30 days. Show me the call log. Show me how you're trying to get in touch with them, because the last thing this industry needs is to kick a bunch of people out of forbearance because we couldn't get in touch with them, and then we charge them. And then we start reporting them delinquent. That's going to play very poorly that would play very poorly under the previous administration of the CFPB. It's going to play extremely poorly under this, and it's going to result in more fines. I pulled some data for a different presentation, and from a CFPB perspective, 2020 was the second most active year in terms of actions taken by the CFPB. So the CFPB was actually very active in 2020 in terms of enforcement actions. But the difference was the fines were de minimis. The fines were extreme in 2014 and 15. The actions taken were a lot by the CFPB. They've been very active. They just haven't been very active in that fining mode. And that's where we're headed back to, in my opinion, with the new director of the CFPB. That's where it started. That's where we're headed back. And that's a wild pendulum swing. That to me is somewhat untenable for any industry.
Yeah, it honestly, as you're sitting there talking, I don't want to sound too cynical or, whatever, but it just seems like we have a perfect storm of a lot of people new into servicing, a lot of people, new sub-servicers in the space. And then, this whole forbearance issue coming to, all at the same time. I mean, it seems like it's just going to be, could potentially be a big mess, here shortly if,
Well, and let's not forget the last financial crisis we had. 90% of the servicing was at banks who are deep pockets, right? At the end of the day, I was at SunTrust. They took the total number of loans we originated over a period of time and said, your fine is X dollars per loan and you better write a check. And we fought it for a while. And then every equity call, it came up. So eventually you just paid the fine. Let's not forget that there are some very, very large originators that are now publicly traded companies over the last 180 days, right? Those were privately held companies, and now they are public. That puts them in a different lens and puts them in a different light, in my opinion, and certainly a different risk category. And I'm not saying that they shouldn't have gone public, but going public in this time frame, while it's great from the origination gain on sale margin, may be one where you're stepping into a regulatory bear trap, and we'll see how they behave. But banks, for a lot of reasons, don't originate Ginnie Mae loans, right? Don't like the DOJ risk, don't like the false claims risk, don't like it. Banks got out of that business. Well, the independents, to their credit, stepped in, and those independents are providing access to credit and to first-time home buyers. It's critical to the overall housing economy and the ecosystem there. But boy, if they start levying fines, that is going to be a problem for those IMBs that originated the product.
Perfect. Thanks. Hey, we actually have a question, which is something we were going to touch on here in a minute, so we might as well get right into this. It's buying delinquent loans out of Ginnie Mae pool. So the question is, buying delinquent Ginnie Mae loans out of pools, have a provider or special servicer to help bring them current, and then after a few months, bring them back into the pool. So can you just kind of talk, we had that on our agenda item to talk about anyway, so we might as well jump right into that. Can you just kind of talk about, buying them out? Are you seeing people buying a lot out? Are they holding them a lot? It gets in a little bit, as you're probably aware, the accounting of it's a little bit, odd. So why don't you talk about it first, and we can talk a little bit about the accounting of it and the disclosures and stuff like that.
Yeah, I'll leave the accounting up to you because I see your financial statements where there was the gross up of Ginnie Mae loans eligible for buyout that people don't have. And again, that's the accounting side. So, Ginnie Mae has always had a policy. After 3 missed payments, you could buy a loan out of the pool and then in essence make it a whole loan on your balance sheet and stop advancing the P&I or principal and interest payments. And that has always been the Ginnie Mae rule, kind of the 90-day rule. In fact, I know there's at least one person on the call that's got gray hair like I do, even though I keep cutting it short and short so you can't see it. It's a new strategy of mine. But that used to actually be able to buy out rolling 30s, which if a loan was 4 times 30 in a period of time, you can actually buy them out. They long since stopped that because, trust me, as a bank, we were making a lot of money on rolling 30s becoming current. But anyway, so 90 days. At 90 days, you could buy out the loan. The Ginnie Mae rules are so structured that they never sort of contemplated, rightly or wrongly, forbearance. And so there was a big question when this first came around, sort of last summer after about 90 days into the CARES Act, is, can we buy these loans out of the pool? I remember Ginnie Mae, when you buy those loans out of the pools, it's a prepayment. It impacts the bondholder. And, Ginnie Mae speeds, let's just say, have been fast. And so Ginnie, in an attempt to not sort of change the complete game rules and rewrite all their rules, added on an all APM, all participants memo, and said, hey, if you do buy out sort of these CARES Act loans they have to make 6 months of payments before you could sort of re-securitize them. The old rules were as soon as it became current, you're good. And I don't want to get too far into the topic because I've been on enough MBA calls where I've heard conflicting things. A lot of people believe, and I'm not expressing this as a rule, but a lot of people believe, hey, that applies to all Ginnie Mae loans that you're buying out, unless you're doing a true modification to it, that you need that 6 months of seasoning to re-securitize them. So there's more risk there now to buy those loans out of the pools. But have people been doing it? Absolutely. Now, they were buying those loans out of the pools, if you remember, when rates were sub 3%, and mortgage rates have come up. And so one of the kickers is that 6 month seasoning requirement. Are rates moving enough that loan, if it reperforms, is now underwater in terms of what you would sell it for, because interest rates have moved, and that's a risk. We probably haven't gotten to far enough, so it's going to be a huge problem. But if rates continue to move up as they have been, that could be a problem, and that could be a real financial risk. And so that's the rule. People have been doing it. People have been buying them out. We're getting up to that 6 month seasoning. We have to put them into custom pools to re-securitize them. But the accounting question and that tangible net benefit question is the question that I get a lot, as you might imagine, for folks. And I just kicked the can down the road, so talk to your accountants. I passed the CPA exam when FAS 91 was the cool rule, not this stuff. So I don't have to worry about that. But it's that tangible net benefit. And I would make the argument that there is tangible net benefit because you're at least stopping principal and interest payments. But it's been an active market. There's people buying a lot of them out of the pools, particularly the banks, and it's sort of standard business practice. But I'll turn the accounting over to you because that's a tough question.
Yeah, no, the accounting, like a few accounting issues in the space, just doesn't make sense. It's a weird rule, and in terms of there's a very specific pronouncement that talks about, if there's more than a trivial benefit to doing this stuff, then you have the control to buy this out, and you need to put it on your balance sheet, regardless if you plan to buy it out, if you're going to buy it out, if you have bought it out, you have to gross up your balance sheet. So really what you're doing is you're debiting asset, crediting a liability for a Ginnie Mae repurchase obligation is what it is. The trivial benefit is a hard thing. I think, it's been a discussion. It was a discussion when it came up. I think everybody's talked about it. I think a lot of in Seth's point, a lot of people have erred on the side that, just the fact that you can do this, you have more than a trivial benefit. The fact that you can buy them out of it, you have the option to buy them out is more than a trivial benefit. So, there's the argument that you should be doing it. There's the other argument that, just business case, does it, you're just grossing up a balance sheet. Doesn't make sense if you just disclose it. So, if clients can clients can put together a sophisticated memo, sophisticated discussion on what, why it's not more than a trivial benefit. Typically we're okay disclosing it and just putting it, but it does need to be in the disclosures. We have this number of loans that are over 90 days delinquent or in foreclosure, and that's kind of how we treat it, and how we've kind of seen it treated across the board. Some firms are a little bit more strict, some are a little bit looser on it. So yeah, I mean that's kind of just high level. I mean, we could talk about this, and get into the intricacies, but I think that'd bore a lot of people on this call. So I guess talking, I want to spend some time here at the end talking about just what's coming, as you referred to it, the cash squeeze and stuff like that. I'm trying to see if there's anything else before we get to that. Oh, one thing I did want to cover real quick before we get into that is just, we had some weird issues. Again, something I haven't seen in 15 years of doing this in the independent space. With what happened to this is getting way over my head. So we had a call probably 2 months ago to talk about this, or a month ago. What happened with the spec pools and how we had clients that all of a sudden created excess servicing without knowing it, which, I think you're aware. And for those that aren't, that there's a tax issue when you create excess servicing and you have to pay tax on this stuff. So if you just touch real quickly on just kind of like what that is, or is it still happening? I mean, I think at the end of the year, we've determined it's been immaterial for tax purposes for the most part, but just kind of talk through that just briefly.
Yeah, and it actually will be a bigger issue potentially going forward with the UMBS. And I know that our friends at Fannie and Freddie will kick me, and they're like, well, you can create excess when you do cash window deliveries. I'm like, yeah, I know you can create excess. Nobody does, but you can. But some folks were. But for a lot of your entities that may have been a slightly larger entity that were doing sort of UMBS or creating securities, as rates fall, you have that 3.25% loan that you're trying to put into maybe a lower security, because that's where the better pricing is on the security side. So you're creating a larger servicing strip. And so in the UMBS rules, I know you can create at least a 75 basis point strip. I've seen over 100. I think they try to cap that down, as you can only have so many coupons in the stack. And your pipeline advisory firms can certainly give you those rules as to what you could do. But if you create above a 25 basis point servicing strip under tax rules, you're creating a tax asset. That becomes a taxable item day one. If you create safe harbor, which is 25 basis points for Fannie and Freddie, or 44 basis points for Ginnie, you're okay from a tax side. So that tax asset, at a bank like SunTrust, we actually ran, an excess valuation, which was, okay, all our MBSs that we created more than 25 and all our Ginnies we created more than 44. We ran an additional valuation and you paid taxes on it. The sad reality is I think there's only like 12 people in the country that understand the tax rules, and I'm really not one of them, but I just know enough to talk about it. But you do create that excess servicing strip, and it is a taxable event, and theoretically you should provide a tax valuation because it's going to be a 9 years amortized straight line asset as opposed to no asset. But I guess on the good news front, it won't be good news. As Washington, D.C. looks for ways to pay for the $1.9 trillion bailout here and the other bailouts here, servicing may, there's a significant risk that there is a risk that's above zero that the tax rules around the MSR asset could change. We almost lost the tax deferment with the Trump tax plan because they were looking for ways to fund it. I was getting calls as I was trying to do my Saturday morning shopping from the MBA going, is this going to be a big issue? Yes, this will be the end of mortgage banking as you know it for a lot of IMBs. And so we almost lost it then. We didn't, but it is something to be aware of. In the shameless plug department, if you're not sort of an MBA member and hearing what's going on or doing advocacy, you certainly need to be. It's more critical than ever this year. There's potential that, a lot of independent mortgage companies maintain servicing for a year in order to sell it in a bulk package, a year later and get at least some capital gains treatment on it. Well, if they change the capital gains rule so it's taxed as ordinary income, that affects the MSR asset, it'll affect all those trades, right? It doesn't affect your cash, just affects your taxes, which does affect your cash, right? And so And the second one is if they make MSRs taxable day one, i.e. whatever you capitalize it for, you're going to pay taxes on it. That's going to be a radical change to the industry, because at that point, unless you're an IMB that's really doing sort of recapture, or you really have this strong value proposition with your customers, why would you keep servicing? Like, there's no tax benefit. You're actually cash negative, because now you're going to pay taxes day one on the value of servicing. That will forever change the servicing asset and forever change the servicing landscape. NBA is obviously aware of this issue. Bill Kilmer brings it up on every one of these calls that they have, but there could be some really big time changes here in the servicing as they look for ways to pay for the 1.9 trillion and the 3 trillion other infrastructure packages. And so we'll see what happens, but it's something just to be aware of. If you've built your strategy on, I keep MSRs because I don't like paying taxes, that may not be the strategy that may work out in the long run.
Yeah, I mean, I will echo what you said earlier about the NBA. I mean, it was impressive. If you weren't around or you weren't part of that, it was impressive with how fast they mobilized and got that taken out of the last tax bill. I think because for the original tax bill had that. I mean, it was like what, like a 2-sentence little thing in the tax bill that would threw the whole industry into a I mean, and the NBA did a great job of mobilizing the forces and getting it removed, because that would have been a big issue.
Yeah, it showed up on a Friday night, and by the following Friday they had it taken out. But it was tenuous there that it was touch and go, and there were a lot of us involved in sort of trying to get it out. But yeah, it would have been very bad.
Yeah, for sure. Okay, let's talk, and then we'll leave a few minutes at the end for questions. Let's just talk. I mean, you referred to it on the call as the cash squeeze coming up, or whatever. Just all impacts of the cash of what's going to happen here, in the next little bit with shrinking, origination margins, servicing advances, and whatnot. And then we can talk a little bit about selling portfolio at the end of that, and then leave some questions. So why don't you start with that?
Yeah. Well, and again, I'm not trying to be overly negative on this call, but I just, part of being in the consulting space is to try to tell people, these are things that you at least need to be considering. And as we had a prep call, I kind of built out the perfect scenario, right? You're an independent mortgage banker that traditionally sold to an aggregator, but now you sold direct to the agency, so you kept servicing. Okay, so now you're in the servicing asset. Whether or not you understand the servicing asset, understand the cash flows is a separate question, but you've made advances. So when are you going to get those advances back? The second part of that is repurchases, right? What are the repurchase demands of those indemnification letters from the agencies? Are you going to need for the origination defects? And I'm not saying that this isn't 2007 and 2008 where it's like these make holes were ridiculous sums of monies, but there's going to be a lot of indemnification letters, I believe, coming out of this. If you're going to sell your company at some point, those indemnification letters are going to follow you unless you kind of keep the shell company and you sort of bifurcate these risks. So it's something to be aware of. It's definitely a risk that I think you'll see increase in repurchase demand. In fact, ACES came out with their latest study, and number of critical defects was up in Q3 2020. Not surprising, right? More people were just selling stuff to the agency. So there's a cash strain there. You've got narrowing origination margins, and again, let's start with the facts here. Q1 is typically a quarter where independent mortgage companies lose money, right? There's not a lot of production. There's not a lot of gain on sale. They typically start the year in the red. They're not going to start the year in the red. They may not make as much money as they did in the fourth quarter, but they're making money. There's good volumes. And so you're starting the year in a better position. So I generally feel like 2021 is going to be a fine year for independent mortgage companies and mortgage banks in general, because there's more volume here, at least in the first half of the year, which is traditionally slow. But we're seeing spec pool payups disappear, right? In a rising rate environment, all of a sudden the bondholders don't need spec pool payups, the payment protection. So there's a little bit of loss there. that you're going to experience. On the UMBS side of the market, right? If you have to create UMBS securities, you're now changing your cash situation, right? You're used to delivering actual through the cash window, being paid 48 hours later. You're now on SIFMA settlement dates. Yes, you can do early funding. Yes, you can do that, but there's 4 settlements during the month. So if you think about an IMB's cash flow situation, they're kind of getting this one check in from their subservicer between the 5th and the 10th, which is their net servicing fee revenue less what they're paying the subservicer, less advances. We're hoping it's a positive number, right? And now if you change that to your settlements start to be UMBS next year because you can't deliver to the cash window, that's going to start to look like a slug of cash once a month or twice a month, as opposed to throughout the month. And I just think that the IMBs just need to be very much aware of that cash situation and the potential cash drain, the greater need probably for financing, the greater need to really be active on the day-to-day management of cash. And it's not necessarily that they don't have enough cash sort of across a cycle. It's just that they may not have the cash when they need it, like to pay for payroll or to pay accounts payable. And it's just putting that massive squeeze, I think, on the IMBs in general that aren't sort of used to that. And to some degree, I think that leads to the M&A side, right? I mean, I think you need to get bigger. I think you need to be able to create. I don't believe. I mean, I'm not an economist and I don't run the capital markets team, but if you're creating 1.5 billion of Fannie Mae's a year and now you have to create MBSs out of that, I don't think that's enough volume to sort of maximize your MBS deliveries, right? Between spec pools and other things, given dwell times on warehouse lines, et cetera. And so I think you need to get bigger. And so I think that's where you're going to see a lot of M&A activity just from people going, I just need to be bigger. I need more originations in order to sort of manage the risks appropriately across the new paradigm of mortgage. Now, some of this can come off the table, right? Maybe the $1.5 billion cap goes away, but we're end of March almost, and you got 9 months to figure it out. And, there's a lot of changes still being thrown mortgage companies' ways. So it's one of those, you could create a scenario pretty quickly where the cash situation of an IMB looks radically different 6 to 9 months now, and certainly in 2022 than it does today. You're flush with cash today. It's great, making great margin. Are you investing in the right technology? Are you investing in the right process and systems? Are you investing that money appropriately? Maybe servicing isn't for you. Maybe servicing is for you, but you really do need to understand those risks and the cash flows. And that's where I spend a lot of time trying to help people just manage that cash situation. The servicing values are servicing values. You can get those from a variety of firms. I don't provide servicing valuation work, but I also provide oversight on those valuations, because you just can't. When Dustin walks into your office and says, well, I got a valuation from XYZ firm and I booked it, Dustin's going to go, well, how'd you verify the number? And that's when the deer in the headlight look goes, and that's when Dustin won't be happy.
Well, you mentioned a couple things I just want to touch on real fast. So on servicing on MSR lines, I mean, you mentioned earlier that they went away. Are you seeing them come back? I mean, is that a real, cash way to get some liquidity, or what are you seeing there? Okay.
Yeah. People are much more willing to give. It was hard to negotiate an MSR warehouse line last April. It's way easier to do it at the end of the year. So the liquidity is back there. You get Ginnie Mae EBO lines. Look, there was so much uncertainty last year. Don't forget that the IMBs serve a critical need. We work a lot with the IMBs. Great, well-run companies, but they rely on banks to provide them warehouse lines, financing lines, et cetera. Well, the banks are highly regulated, and the banks can be the first ones that are going to be risk adverse. So it's not necessarily that the IMB is doing anything inappropriate, but they're relying on highly regulated financial institutions, i.e. banks, for their lines of credit. And banks can get conservative very quickly, which could put IMBs out of business because they don't have warehouse lines, they don't have these facilities, et cetera. And so it's all on that risk spectrum. And remember, a lot of those, companies that do, that are in the MSR financing business, they're also in the mortgage business. So they already have this risk somewhere else in their company, and now they're just doubling down on it over here. And so look, we want to keep our people employed. We don't want to blow up the company because we've overextended warehouse lines or overextended MSR financing lines. And so that's where, you're still relying on those banks. And I think that's why you need to be larger as an INB. In the old rules, you try to self-fund yourself, right? You try to self-fund yourself with servicing the gain on sale since you don't have as much reliance there. That's hard to get to that scale.
Yeah, and then the second thing, I mean, with the, I mean, do you see, because you touched on, capital gains treatment, and I don't know if that's going away, if it's not, whatever. I mean, I think we can all speculate on whatever. But are you seeing the sales market come back? I mean, is it and if so, like, has it come back fully, or and then we can talk about the capital gains here in just shortly. So.
Yeah, I think 2021 has been way more active in terms of MSR deals than sort of 2020 was. The flow market, the co-issue flow market never completely collapsed in 2020 like the bulk market, because in the flow market, you're kind of selling current production. And outside of that March, April, maybe part of May, the flow buyers came back in quickly. In fact, by the end of the year, I'd say their levels were probably back to pretty close to pre-COVID levels. The aggregators have certainly become more aggressive in 2021 with servicing values and paying up for servicing. They're pack manning as much as they can, which is good for the IMBs. It makes them hard to retain servicing, which may or may not be a good strategy for them long term. The bulk market has been slow to come back, but there has been several very large transactions, some of them public, some of them not so public. But servicing values for high 2-3% 30-year fixed rate mortgages, it's well above a 4 multiple again, and that's pretty much where it was pre the financial crisis. In fact, it may have been better, right? We did see 5 multiples touched, 5 multiple servicing fee. So on 25 strip, we're talking 125 plus price. We saw low 5 multiples in November of 2018 when rates touched 5%. I think that's the high watermark that people are looking to get back to, but it's getting closer. There still is a lack of liquidity on the Ginnie Mae side, mainly due to the difference between where people have it marked on their financials and where the bidders want to buy it. So the gap on the Ginnie Mae side is wide. We'll see if that narrows some throughout the year, but I would expect that you'll see a lot of people attempt to do a capital gains treatment sale second half of this year. I don't know how late in the year you could change capital gains rules. At risk to me is the capital gains treatment for MSRs in a big way, right? I mean, I think what they're going to do is over a certain income threshold, your capital gains treatment is taxed at ordinary income. I could see that as an easy sell with the current attitudes in DC, which would impact a lot of independent mortgage companies because they're pass-through entities and personal taxes. And so, you're not going to get that capital gains treatment. That's, to me, that's a body blow. Taxing MSRs initially upfront, that's the knockout punch, right? That significantly changes the entire landscape. It probably moves to banks or to other sort of investment vehicles because I just don't see the IMBs being able to pay the taxes up front on the servicing, because if you do that, you may as well just sell it servicing release. So it's really good for the aggregators.
Yeah. Well, thank you, Seth. The one thing to touch on the capital gains, I want to touch on in your experience, you've always seen like a bifurcated approach to capital gains, right? I mean, we're not talking full 100% capital gains for all of it. I mean, you have to hold it over a year. I think we all know that. But then you kind of bifurcated in what's considered. What's the fancy term?
Ordinary income versus ordinary income excess gains. I tell people you should think about 50% of that MSR asset gain cash being capital gains. The other 50% is ordinary income. I've seen 75 of some people try to get through that. 50-50 seems like a decent split to me when you start thinking about base cost of service and your discount rate yield requirement. Something in that 50-55 range of capital gains makes sense to me. 90 doesn't and 5% doesn't. Something in that 50% range makes sense to me.
Okay. Well, sounds good. Yeah. Want to talk on that. Well, thank you, Seth. This has been great. I mean, I know we had one unanswered question, which we'll get back to. It's a tax question anyway, so it's not for you, Seth, anyway. So, So yeah, well, thank you very much.
That's almost a
Great.
CPA though, Dustin. So
Well,
he
that's
could
true.
probably,
That's true.
I mean, he could answer that. So.
Well, so yeah, we appreciate it. So yeah, I guess go ahead, Casey, you can wrap us up here. And
yeah, you bet. Hey, great stuff, you guys. Thanks so much for your time and for everybody's time that joined us today. And as I mentioned at the top of the call, we'll go ahead and send out a recording either the end of today or tomorrow. And keep an eye out for our May webinar. And if anybody has any great top of mind ideas, we'd love to hear them. And again, Dustin, Seth, thank you so very much. Take care, everybody.
Have a good day.
Thank you, Seth. Have a great day, guys.